evening, everyone. Before we get started tonight, I'd like to remind all of our guests that this webcast will be recorded and the ideas, views, and forecasts in this presentation are as of tonight's date, the date of our presentation. They're subject to change without notice, may prove incorrect, and do not represent a recommendation or offer of any particular security or investment. Telarray has no obligation to provide revised assessments in the event that circumstances change. There's no guarantee that the strategies described will achieve stated goals. Investing is a fundamentally uncertain process, and Telarray cannot predict the future or guarantee any specific investment results. This material represents Telarray's intellectual property and may not be published, reproduced, transmitted, or rebroadcast in any form without the express written permission of Telarray. I am Chelsea Sloan, Director of People Experience at Telarray, and I want to welcome everyone to tonight's market update with our presenter, Chief Investment Officer, Jean Gard. I'll be taking your questions through the chat box, and be sure to stick around at the end. If time allows, we'll be glad to answer any questions that come in throughout the end of the presentation. Thank you to everyone who has joined us this evening, and Jean, I will give it to you.
All right, thank you so much, Chelsea. I really appreciate it. We're doing another one of these market update seminars, which we've done these a little bit more frequently than usual. I think most of you know we're on a every 2-week schedule, and so we try to intermix actual market updates with other content that might be interesting to our clients and other people out there. But there's just so much going on in the market that it's hard to ignore that. So we're doing these a little bit more frequently than usual. So we'll go ahead and get started. Let me go ahead and share our slides here. And let's see, there we go. Yeah, so here we go. So the first thing I'd say is obviously the only thing on most people's mind right now is the Fed. And I think that's probably been true most of the year. And it's sort of always true to some extent, but the Fed seems to have unusual power right now. And I would say that's probably because the Fed is taking unusually strong action. They want to appear credible. They want to fight inflation. If you recall, Chairman Powell has had some credibility issues in the past where, they at one point early in his tenure, they said they were going to very aggressively hike interest rates, and there was a little bit of disruption in the market, and they rapidly backed away from that plan. So I think he's learned his lesson this time, and he's intending to be credible. With that said, I think he'll be very happy to back off very quickly if we do have signs of showing inflation is turning. But given the current setup and what's going on, that may be a few months or more away. So we'll go ahead and get into the presentation. Actually, most of the Fed content, which I know is probably the most interesting, is towards the end, but we have a lot of interesting stuff to show in the meantime. So we'll start out and focus on the stock market to begin with. As you can see, this is the S&P 500, which if you look, it feels like the S&P is down and the markets in general are down pretty aggressively right now. But really, if you look, I mean, we're really only sort of around late 2021 sort of level, actually late 2020, early 2021 sort of levels in the S&P 500, which of course were all-time highs just a little bit ago, really less than 2 years ago. So this period here has been painful, but at the same time, it's not unprecedented. It's not unusual. There's been many drawdowns like this in the market, so it's nothing. It's something to be concerned about, but I'd say it's nothing to be alarmed about. This slide here shows some of the indices that we track internally, just to kind of get a sense of what's going on in the market. And really, there's so much noise right now. I'd say let's focus on the year-to-date column. I think the same trends that we've been seeing throughout the year continue to persist, and that primarily is that if you look at the heat map here, each column is its own color coding. So year to date, the things that really aren't working are things like the NASDAQ composite, the Russell 2000 growth index. You can see they're both down about 27%. The S&P 500 growth is down 25%, and you can see the other things we track are working much better. And in this market environment, there's a lot of negative sentiment about bonds. bonds are over, bonds are dead. You'd be a fool to allocate to bonds, and we would disagree with that. And in fact, if you look, even the Bloomberg Global Aggregate, which is a relatively long duration bond index, is down almost 15% year to date, which is not good. In fact, it's towards the worst end of what we've experienced in those sorts of indices in the past. But with that said, it's still providing meaningful ballast against the equity market downturn if you're in the S&P 500, or especially if you're in something like the NASDAQ or some of these more growth themed indices. So I would agree that bonds aren't providing a meaningful source of real return right now, but certainly I would say that they are providing some cushion and a source of cash to rebalance into stocks in this market downturn. So I think the death of bonds has been greatly overstated. I think this chart is interesting just to get some perspective. This shows the 10-year rolling returns of the S&P 500. So what this means is if you picked sort of a random spot on this chart, let's say right here, what that would indicate is that if you would, I'm trying to get the 1970 line here, and what that means is in 1970, had you been, well, this is going to drive me crazy. Had you been invested in the S&P 500 for the previous 10 years, say from 1960 to 1970, you would have turned $100 into, looking at the scale, maybe $110, $120. So definitely not a good period. But what it really shows is there's been shockingly few periods where if you'd put $1 or $100 or whatever in the S&P 500, that 10 years later you would have lost money. You can see there's a few observations like that around here. Shortly after the financial crisis, which was a double dip kind of market downturn after the tech crash in 2000, you would have lost a little money over a 10-year period. But you can see they're few and far between, and still, kind of like we were showing in the first chart, you're still, if you'd invested 10 years ago in the S&P, even with this downturn and the other downturns we've experienced in the last 10 years, you'd be still doing pretty well, which is, in my opinion, not an anomaly. It's funny, I look online and I just kind of read message boards to see the kind of things that people are concerned about. And this one person said, there was a young person, and they said, well, I can't remember exactly what the question was about. It had something to do with asset location, like using a Roth IRA or a traditional IRA or a 401k or a taxable account. And they said, if I invested in the market now, 40 years from now, when I retire, when I'm in my 60s, the market fluctuates up and down. So what if the market happens to fluctuate down and I'm still underwater and have lost money 40 years later? And I guess that's possible if we had some sort of Great Depression 2.0 kind of scenario over the next multi-decade period. But the chances of there are shockingly few observations of negative returns over a 10-year period in the stock markets. And the idea of having a negative experience over a 40-year period is, again, I guess it's possible, but it would be completely unprecedented. So we don't want to say the stock market always goes up, but as long as the forces that have brought it up over the previous decades and centuries continues to exist, like productivity growth, population not being dramatically declining at least, and GDP rising and stuff like that, and there's every reason to believe the market will continue to work. So looking at specifically what is working, you can see this chart is it sort of holds the S&P 500 constant, and then it shows you what underperforms and outperforms it in any given year. So this year, the S&P is down almost 20%, and you can see commodities, obviously led by gas prices, are doing very well, as well as other food products. Fixed income, according to whichever index they're using here, which it's probably some sort of aggregate index, you can see, again, it's not great performance. It's probably the worst performance, almost certainly, you can find on this chart for fixed income since 2006, but it's still a lot better than some of the alternatives. And again, the balanced portfolio here, it continues to show that a 60-40 continues to work. Emerging markets are challenged right now with the conflict in Ukraine. Developed non-US markets are challenged as well. We'll talk about that. And small cap, particularly unprofitable small cap growth, is struggling the most, which fortunately we have a relatively limited exposure to that. So Something that's driving the general market downturn as well as the S&P's performance is what these large tech companies have done. And you can see over the last 5 years or so, they had really unprecedented outperformance. You can see this blue line represents the 5 major large tech companies. Even just the general S&P 500 tech index was performing extremely well. And this red line shows the S&P 500 itself. But what's remarkable is rapidly we're going back to parity where this reversion to the mean is happening. And the 5-year return approximately of the FANG stocks is actually starting to look comparable to the S&P 500 itself. So that sort of shows the dramatic outperformance of the things in the S&P 500 that aren't the, I've heard the saying, the S&P 5 versus the S&P 495. So for our style of investing, which doesn't focus on these sort of companies, that's been pretty good news over the last couple of years. And I like to show this, we've talked about this before, but I think this is a really compelling chart. What you see here, the gray line is consumer sentiment, which you can see ebbs and flows and goes up and down. But what's absolutely fascinating to me about this is the blue dots show an observation at the peaks and troughs of consumer sentiment. The blue dots show the market performance over the next year from that point. So you can see it seems like every time consumer sentiment gets really low and has a local minima, the market tends to do pretty well over the next year. You can see from this low point of consumer sentiment, the market did 22% from there. This one, 20%, almost 30%, 32%. You could see, and when consumer sentiment peaks and gets really high, market performance is really poor. And since the last time we talked about this chart, it was probably somewhere around here. Consumer sentiment has gotten even worse, and as you can see, the worst observation since 1971 at least. And you know, we're not sure exactly what the next year is going to hold in the stock market, but if this chart is any guide, then I wouldn't bet against the stock market in the coming year, which is reassuring. Talking more about valuations, there was a period of time over the last few years, particularly driven by the FANG stock driven rise, where it didn't feel good to invest in domestic US stocks. And the valuations were very high. And again, that doesn't mean the share price, but it means things like price to earnings ratio, price to book ratio, things like that seemed elevated compared to historic standards. And they were, but the problem is, if you look back probably to 2017, the stock market might have looked above average as far as valuations, or 2018. And so you can't trade on something like that and just expect the reversion to the mean to happen quickly. And obviously in this case, I mean, we can just go back to this chart. You know, right here, well, in 2020, right before that's probably not the best example, but even here, when going into mid 2018, the FANG stocks had dramatically outperformed. If you'd sold them then, you would have missed out on this big rise here. And just like there was no reason to know at this peak that they were going to turn around, they could have outperformed for another couple of years. That's why we don't try to time the market here at Telarray. We really just try to allocate appropriately to the market in vehicles that can be rebalanced. So, for example, throughout this entire period, when the S&P was running, we were over time selling the S&P 500 exposure we have and buying the things that had underperformed, like value and small value, international, emerging, all that kind of stuff. So we'd sort of taken some money off the table, you know, in a gambling, I hate gambling analogies, but we'd sort of taken some chips off the table and put them in our pocket so that we participated in this upside. But once we got this downside, we were able to have already put some of that profit to work elsewhere, and vice versa. Now that the S&P is down some and other things have outperformed, those are the types of positions we're rebalancing into now to try to take advantage of that magic of rebalancing, which sort of over time can allow you to sort of systematically buy low and sell high if you're consistent about it. So the point is of all that you can see this red line represents the historical average price to earnings ratio. So, you know, anything you could argue that over the last, since the late 80s, when the blue line's above this red line, that means stocks are a little bit expensive. And when the blue line is below the red line, you could argue that stocks are a little bit cheap. And you can see right now, we rapidly, with the downturn we've had, we've rapidly gone from stocks looking somewhat overvalued to stocks looking somewhat fairly valued compared to historical price to earnings ratios, at least. So I think that's another thing that feels reassuring about staying in the market right now and potentially even committing more capital to the market if you have it available. And this is another way to look at price to earnings ratios. It actually uses an average of the prior 10 years. And you can see, rather than just the most recent, the average of the last 10 years of earnings. And you can see that after this regime sort of shifted after the 80s, at least what we've experienced since the 90s, again, we're getting more to historical norms there, although we may never get back down to these sorts of levels. So, and this is just another way to look at valuations. It shows, this is called a box and whisker plot. So you can see that the scale over here is standard deviations. So for example, if you looked at, we'll just look at price to earnings here. If this dot was right on the zero line, it would mean that the price to earnings ratio is right about at the long-term average, and anything above or below would be above or below the long-term average, obviously. But I think the actual whiskers here represent the 95% of the observations. So you can see this red X here, which shows where we were a year ago, and that looked like we were over 2 standard deviations above average on price to earnings. And that's come down to a much more attractive level. And you can see all of these valuation metrics have come down to a much more attractive level over the last year. So again, they're a little bit above average compared to the range since 2003, but it's much more comfortable to see it more like this. And it gives you a little comfort that you're not overpaying for stocks as you do put new money into the market right now. This slide, I think, is useful. It shows, again, a similar trend. You can see that, so this is price to earnings ratios for the S&P 500, which is US based, the MSCI EFA, which is developed non-US stocks, and then the MSCI Emerging Market Index, which is obviously non-US emerging markets. And you can see for a while, it felt that the US was a little bit overvalued, and developed non-US and emerging were sort of fairly valued. And now, if anything, the US has come back sort of more in line with its historical average over the last 10 years or so, although it's still a little above average. But you can see, if anything, developed non-US and even emerging are sort of at their averages or a little bit below. So again, it's reassuring to not have to bet which one of these is going to do the best. If you're a Telarray investor, we have allocations more or less in line with market weights to all 3 of these sort of markets. So as they underperform and outperform each other, our investors do get to participate in all of those. One thing that's really interesting is, so this slide we just looked at is the equity valuations using the price to earnings ratio. But if you examine price to earnings growth, I think it's sort of shocking. Obviously, the thing that stands out is developed non-US, and you can see US earnings growth is a little bit expensive. Emerging market growth, so earnings growth, seems a little bit more fairly valued than the US, and even though it is a little bit above its historical average, but developed non-US is really sort of blown out here. So if anything, going back to this slide, it makes developed non-US not feel quite as cheap as it might look here, just looking at the snapshot of price to earnings ratios. So,
and before we move ahead, we have a question.
Sure.
Can you comment on the reasons that developed non-US has such a high price to earnings growth ratio?
Sure. Well, I should have addressed that. Yeah, absolutely. So I haven't done a lot of specific research on this. So again, I would definitely like to look into this more myself, but I think there's a few things going on. One is that as much as we've been afraid of what the dollar is going to do and been concerned about the dollar with our elevated US debt, our treasury debt and our debt to GDP ratio, the dollar has been absolutely on a tear recently, performing extremely, extremely strongly. So probably one of the biggest things leading to this is that So when you're talking about currencies, there's no such thing as really absolute currency performance. It's all relative. So if the dollar is outperforming and rallying, that means that other currencies must be struggling. And the euro, developed non-US, is heavily weighted towards Europe. And I think that in Europe, I mean, one of the biggest issues is that right now, for the most part, almost 100%, oil is priced in dollars. So what that means for a European company, which, as you know, as green as we want to be and as green as Europe wants to be, everything is sort of oil soaked. It's not just the gas you put in your car, but the transportation of your goods and your services, and almost everything touches oil. So what that means is a very, very strong dollar means that oil has become that much more expensive to Europe, unless it's been hedged, but hedges don't last forever. And I mean, it's actually kind of shocking. We're actually seeing dollar euro parity right now. I mean, when I think about the euro, I think of it being priced at something like $1.30 to a euro, or $1.25 or something like that. That's historically what I recall. And right now it's almost 1-for-1 exactly. So if you went to Europe right now, you could spend dollars as though they were euros, whereas before it took more than $1 to buy a euro. So I think that's a big thing. Obviously, the other big thing, again, not to beat up on Europe, but there's a lot of uncertainty with the Ukraine crisis for a number of reasons. One is there's the threat the conflict could spread, or it could go nuclear. Things like that are probably less of a concern, but a big concern is the energy issue. So some of these countries like Germany and things like that get a lot of their natural gas from either from Ukraine or from Russia directly, which all that's been interrupted and may not continue. So they have energy supply issues as well, which causes all sorts of different behavior. And so there's a lot of headwinds for Europe, I think, and I would be surprised if that's not what's contributing to this. So again, the nice thing is we don't really have to make a hero call here, and we don't have to bet against Europe or bet on Europe or developed non-US or emerging. Again, we start with the entire world, essentially, the world investable equity market. That's what you're invested in here. And then we do have some tilts we do, and we do tilt toward and away certain factors. But if anything is performing well, we're going to participate in it, and vice versa. If things struggle, we will see some downturn there, but we'll be consistent, and we'll catch the next rally in it. And not only that, but we will have invested more in it through our rebalancing process. So I think that's important to remember. That's actually a good segue to talk about our tilts a little bit. Again, we do have a little bit more of a value tilt here than maybe some firms do, and that's been consistent over time, which sometimes works well and sometimes is challenging, but we do believe the research that indicates that in the long run, there is a premium to being invested in value. And again, if I could change one thing about finance, I hate the terms value and growth, because they can mean a lot of different things. I actually wrote a piece on this I could share if anybody's interested, but they can mean a lot of different things. But in the academic sense, when you see a slide like this, what value and growth really mean are cheap and expensive. So value is just, according to the traditional definition, it's just the lower half of price to book ratio firms, whereas growth is the higher half. But there's other valuation metrics used. You can see they use price to earnings ratios here, which is more common these days. But what I wanted to point out is that value has really, it may be surprising. And again, for Telarray clients, I won't talk about specific performance, but you'll see your statements come soon. Our funds and our portfolios have, I would go so far as to say, dramatically outperformed a market cap weighted portfolio in the markets this year and last year. But the reason for that is primarily because of our value tilt. And what's nice to see about that is the next question is, well, that's great that value's done good over the last year or so, but will it continue to do well? Is there still room for value to run? Or is it time to get back into growth? And the answer is we don't have any idea in the short term, but we're not going to try to time it. But what I can reassure you is you can see that this tremendous outperformance we've seen in value has been just this tiny little turn here. So when this gray line goes down, that means that value is underperforming and growth is outperforming, and vice versa. when the gray line goes up, that means value is doing well. And you can see that all the outperformance we've had has just been this little sort of divot right here. So there's nothing saying that we have to revert to the mean or even exceed the mean and go up here like we have in the past. But I would certainly not feel like value is played out and there's no more room for value to run, because it sure looks to me like there is. So, and again, right here, you might say, somewhere around here, you might say, well, value's done really well for so long, it's time to go back to growth. But then there was, a multi-year period where value continued to outperform. So, we don't have any interest in trying to predict factor performance and things like that. We really just want to believe in that long-term slight average outperformance of value. But if I was a market timer, I would be happy about having a value tilt right now, if that makes sense. And on the same note as value, our approach to geographic diversification actually is somewhat in line with a market capitalization sort of weight. So that means, for example, if the US was 60% of the world's stock markets that are investable, we would put 60% in the US and 40% outside the US, which is roughly actually what we do. And so that non-US exposure we've had, sometimes it outperforms, sometimes it underperforms, and we've actually come off a period where it's underperformed somewhat. But again, you can see it's done very well recently, and just this little divot here. So if anything, it's even more pronounced than the opportunity for value, because again, just to get back to the average, there's a tremendous amount of room to run for non-US positions. And I think that makes sense because there's been some tailwinds for US positions over the last 10 years or so, not the least of which that these giant tech companies have sort of become the Godzillas that they are, but that won't last forever. Rob Arnott at Research Affiliates has shown that if you look every decade, every 10 years at the 10 biggest companies in the world, very few of them even make it another 10 years as the biggest companies in the world and underperform after that. And if you they've actually made an index, a research index that looks at just every year that ends in zero. So, 1990, 2000, 2010, if you bought the 10 biggest companies in the world and held them for 10 years, and then rebalanced every 10 years, that index would have abysmal performance. And it wouldn't actually necessarily seem like a bad idea, because right now you'd be buying companies like Facebook and Google and Amazon and Apple and all those things that have just dominated over decades. But in order to dominate that way, they've become the biggest companies in the world, and they just can't keep growing like they are. So even though it feels good to buy companies like that, the evidence doesn't suggest that they will continue to outperform. So the point is, I feel very good. I don't want to time the market. I wouldn't dare guess what's going to happen in the next month or 6 months or year. But again, if I did time the market, I would take comfort in the fact that we're seeing this resurgence in our international positions. And there's a lot of room to run, even just to get back to the average sort of valuation parity that you would see with US stocks. And this is just another way to look at different parts of the world. I think we've incorporated some JP Morgan charts here just because I think they tell a story that's just so compelling, it's hard to even summarize it better than they did. So I just wanted to incorporate them. So what this shows, I think we show this every time these days, but you can see the range of valuations for different parts of the world over the last 25 years, and then show where we are now. So this is, again, price to earnings ratio. So if the observation is up high, that means that thing is expensive. And if it's down low, that means it's cheap. So you can see, just for example, the US has ranged from 9 to 25 times price to earnings ratios over the last 25 years. The average is something like 17 times. And right now we're just below that at 16.1x. So that indicates we're sort of in line with historical valuations. But again, a year ago, well, actually, at the end of last year, so 12/31, you can see we looked much more overvalued in the range. Japan looks crazy. It actually broke the scale because 25 years ago they had some crazy valuations, but you can see that probably influences it. But they were below the long-term average, and now they're even lower than the long-term average. China was and is kind of right at their long-term average, but that's such a manipulated market for various reasons. There's probably not a lot of actionable information you can take from that. But Europe went from being about average to below average, which may again have to do with the earnings growth they're seeing and some of the headwinds, but emerging looks in line with historical valuation. So again, it doesn't look like a bad time to have some non-US exposure here. And the US actually looks pretty attractive too. See how we're doing on time here. So yeah, let's get into the interesting stuff. We're going to talk about inflation, then we'll talk about the Fed a little bit. You can see really, I put this slide first because it's just, it's so critical to inflation. Again, it's not just gas prices at the pump, but gasoline prices and oil prices drive everything from the cost of shipping containers overseas to transportation to airline flights. Everything centers around gasoline. And you can see it's at a pretty much an all-time high, at least in a nominal sense, but you know, there's some indication that it might be turning a little bit, and particularly, I sound like a broken record, but particularly if and when the Ukraine conflict resolves, I think we'll see some definite relief there. And this is really what's driving the core CPI so much higher. I'm sorry, it's driving the headline CPI so much higher than the core CPI. It's just this volatile energy is kind of artificially inflating it. But if gas came back down, then headline CPI could fall significantly below core CPI, which is something we look forward to. So I got this chart yesterday, but of course we had an inflation print today. They were expecting headline CPI at 8.8%, and I think it came in at 9.1%. So that was disappointing. We'll talk about that when we get to the Fed, but it's just something we're going to watch. I mean, it probably guarantees a 75 basis point rate hike by the Fed, but it's one of those things that, you know, the saying is that inflation, the cure for high inflation is high, or the cure for high prices is high prices, meaning that if prices keep rising like this, people are just going to be less willing to pay them, and eventually it'll reduce demand, possibly causing a recession. But you know, we have some unusual things right now that might make a recession less burdensome than typically it would be, such as all the cash on corporate balance sheets and the strong employment demand and job availability. So even if we do have a Fed incurred recession, it seems that it might be somewhat more mild than a typical recession and hopefully not last that long. The good news is that there's some indications, a couple of different indications that inflation will get under control. The first thing is TIPS break-evens. So we don't have to get into the details, but all this really means is that you can buy and sell a certain type of treasury bond that by buying and selling it at the price you traded at, you're making a bet on what future inflation might be. And it's actually quantifiable, and it's very useful. So you can see for a long time, TIPS break-even inflation was around 2%. Obviously, it went pretty low through the lockdowns of 2020, but even with the high inflation we're seeing now, people are betting that over the next 5 years, inflation will average only 2.6%, including tomorrow, if that makes sense. So it's even assuming that starting from a 9% inflation rate, it's going to go down eventually some point below 2.6% over the next 5 years, because it's all going to average out to 2.6%. And 10 years is even more favorable at 2.3%. And again, that's people actually betting on that through the prices they pay for big quantities of securities in the open market. So that's somewhat reassuring. So this is an inflation expectations survey, and I would say that we talked about some other consumer sentiment surveys that are not at all reliable for predicting the future, like, well, the consumer sentiment one we showed, it actually does the opposite. When consumer sentiment is low, that means the market tends to outperform. But this one actually matters, and the reason it matters is because in a lot of ways, consumer expectations about inflation do become reality. I had a mentor who was about 40 years older than I am, and he remembered the 1970s, and he said it used to be that you would buy a car when you could afford one, but he said in the 70s, the idea was you better scrape together some money and go buy a car today, because you might not be able to afford it in 6 months because prices would go up so quickly. So that kind of mindset is what actually causes inflation in some ways, by that demand driven inflation of getting ahead and buying stuff before it goes up. So the good news is, again, the other one we showed was 5-year and 10-year. So just to go back, the 5-year TIPS expectation was 2.6%, and the 5-year consumer survey expectation is 3.1%. So it's a little higher, but they're in line. And I think a lot of us would be very happy if, looking back 5 years from 2027, we could say that we averaged 3% inflation for that period. So housing, and I want to talk about housing. We're doing pretty good on time. I want to talk about housing because I think it's going to be the big story of 2022, but we just don't really have much good data to indicate that. This house price index from Case-Shiller, you can see that the last data point we have is actually April. It hasn't updated, but there's some suggestion that this might start flattening out and turning, which I think would actually be a good thing. If you own a house, I think it doesn't much matter in the short term if it goes up or down. But if you're looking for a house, some house price stability would be very welcomed, to the point that, again, even homeowners that are interested in selling, I think they'd be happy to see a little bit of a decline in the rate of home price growth, if it would just mean that inflation could help get under control a little bit. And even, I mean, at this point, housing is starting to get so aggressively. I mean, what we're seeing in the housing market, I mean, it could even lead to civil unrest. There's a lot of people that are very unhappy with affordability and availability of housing. So I think potentially we could all benefit. Even the most shrewd real estate investor could benefit from a little bit of stability in house prices. This is a little bit newer data. Housing starts, you can see it turned down just slightly, but it's good to see that housing starts remain strong, because, again, that's something else that will help bring down house prices the more supply we can create. And you can see that single family housing as well as multifamily are both on a trajectory of increasing building. Building permits is a similar story. There's been a little bit of a downturn, but it doesn't look like we're going to break that trend line anytime soon. And sales have also slowed. So the last data point here is the end of May 2022, and you can see, unfortunately, I wish this chart went back a little further. I could pull some data to see what that looks like, but it feels like this is probably a more normal level from historical standards we can see. But I think just some of that continuing decline in cooling down of the housing market would be welcome. And this is actually pretty compelling. Month supply of inventory, it got pretty low, especially right after the lockdowns of 2020 started, but we've actually rebounded relatively quickly to much more inventory on the housing market than we really have seen for the last 10 years or so. You can see we're getting into levels not seen since the kind of the blow off from the housing bubble that was going off around in 2008. So again, this increasing supply, I've already heard stories. In fact, just today on the radio, I was hearing that even in Los Angeles, which was an incredibly hot market, houses are being sold at asking price. People are not waiving contingencies anymore. People are not waiving inspections. People are asking for repairs. So it's becoming much more like, I would say, we've seen historically, and maybe the housing market should be. And refinancing, this isn't surprising at all, because the story, again, the big story, in my opinion, is the sharp rise in mortgage rates. The 30-year fixed mortgage rate is above 5%, and it was below 3%, approaching 2% for some period of time. And we have some good charts that show the affordability. Essentially, if you think about a fixed principal and interest payment at various mortgage rates, you'd be shocked to see the dramatic change in how much house you can buy for a fixed payment if you just adjust the mortgage rate slightly. So we can, if you're interested, we can send that to you, or we'll bring it out for the next presentation like this. But it has a massive impact on house prices for sure. So that's also suggesting cooling. So I try not to predict the future, and I'm the first to disclaim and say that I have no power to predict the future. So don't believe anything I say. But If I was predicting the future, I would be shocked if we didn't see a downturn in the Case-Shiller index for housing prices into the end of the year here. But again, that's just my guess. So the yield curve, we kind of saved the best for last year. I think this is some of the most important stuff. This shows the yield curve at the end of last year, the end of last quarter, which of course was only June 30th, and then currently. So put a pin in that. What I'm actually going to show you is one that we printed off at the end of June, because I think it's more telling. It shows, again, the red line is at the end of last year. The yellow line is at the end of first quarter, and then this blue line is essentially now, right at the end of second quarter. And you can see, again, the two things that have happened that have really changed the yield curve this year is, one, that the Fed has hiked short-term rates, hiked the Fed funds rate, but more importantly is what they're doing with their balance sheet, they call it, with their they can create money out of thin air. They can't just go hand it out to people on the street, but what they can do is they have an unlimited ability to create dollars and go out either to the Treasury or to the secondary market and buy financial assets. So buy Treasury bonds and things like that. And they've bought trillions and trillions of dollars of them over the last couple of years, which has brought down interest rates and brought down the yield curve and brought down mortgage rates and all those sorts of things to stimulate the economy. And now they need to normalize. So in March, they stopped buying bonds altogether. They've been tapering down from buying something like 95 billion a month. And so they stopped in March. And then in June, they've announced that they're going to start selling these treasuries, and they're going to try to taper up, so to speak, to a rate of about 95 billion a month that they're selling. So everything that I talked about, that all that bond buying did to support the economy, it's sort of undoing and not supporting the economy. So, there's this sort of nice steep yield curve that existed at the end of last year where, the 30-year never got above 2%. It seemed like as soon as it crept above 2%, it magically would get pushed back down by some big buyer buying 30-year treasuries, which was probably the Fed. But now that, again, not only can the Fed not push down the yield curve, but the only thing they can really do is they can decide which part they're going to push up the most. So as they're selling bonds, if they said, well, the 10-year is a little bit low here, we'll sell some 10 years to kind of get it in line with the rest of the curve. They could do that, but they are not exercising their ability to control the yield curve down like they have recently. So that's why there's been such a dramatic shift. And this is a seismic change in the bond market. For this to happen really in about a 6-month period is very, very dramatic. And you can see it's already yield curve inversion, we've talked about before, is an issue because it tends to predict recessions. And the most common part of the yield curve looked at for inversions is the 2-year to 10-year part of the curve, which you can see, well, when this was printed, actually, let's go back to the current one. We have inverted again. So you can see the 2-year is at 3.07% here, but the 10-year is at 2.99%. So the curve actually slopes downward for that area, which unfortunately tends to predict recession. So you can see that 10-year to 2-year portion of the curve, every time it goes below this 0% line and inverts, almost always it does predict a recession. You can see there. And there's been a couple of places right here. It took about 3 years for there actually to be a recession. It actually remarkably predicted the COVID recession, although that might have been just that we were sort of due for a recession anyway. And now it's predicting one again, which perhaps is the recession we deserved back then, but we've put it off with all this extraordinary support we've provided the market over the last couple of years. But it does suggest a recession is coming. But again, usually it takes at least 12 to 18 months for a recession to materialize when the yield curve inverts. And again, there's reason to suggest that when we do get a recession, if we get a recession, it might be more mild than traditional recession. So that is somewhat reassuring. We should have put this back in the housing section, but you can see this is a really unprecedented spike here in mortgage rates. I mean, I think, again, I'll use the term seismic. I think this is going to have a seismic impact on the housing market in the second half of 2022 if mortgage rates stay at a level similar to this. we haven't seen rates like this since really going into the 2008 financial crisis. So this is a game changer. I guess we got a little bit close in 2018, 2019, but this should definitely cool the housing market, in my opinion. Just closing the loop on rates. This is, if you've been on these presentations before, we kind of beat this to death, but it just shows Ray Dalio's point that rather than cash is king, you can say sort of cash is trash right now. That if you get $100,000 in basically a 1-year CD, $100,000, you'll earn about $210 in interest over that period, and really you'll lose about $8,000 in purchasing power, which is really remarkable that real rates are so low right now. We always take a look at this, and you can see that. So what this really means is, if you look at the safest bonds compared to the riskiest bonds from a credit quality standpoint, this chart sort of answers the question: are you getting paid to take more risk in the bond market? And the way you know that is the riskiest bonds on here are these CCC bonds, which are almost in default, basically. And you can see right now there's a big spread between AAA yields and CCC yields, which means you are getting paid somewhat to take that risk. There's been periods where there's been very little difference in those yields. So if anything, that makes slightly lower credit quality bonds more attractive. And we do have some funds in our bond portfolio that have some flexibility, so that when yields are higher and the spreads, they call them, are wider, they can take advantage of that. And I would suspect that as we're seeing these spreads widen, that that'll be additive to our yields we'll experience in some of our bond funds. And again, our bond funds aren't buying things that are about to default. When I say our bond funds have some flexibility, it means instead of AAA and AA type bonds, they can buy something more like single A, potentially into like the BBB level, which is usually considered the bottom level of investment grade bonds. But we are involved in this part of the curve. We're not looking at these riskiest sort of bonds up here. I think this is an interesting chart, just showing for corporations their debt to EBITDA. So basically, how much debt do these companies have? The companies we invest in have. And the good news is, again, this kind of is good news, I think, from a recessionary standpoint. The answer is the debt to EBITDA is very low. So these companies are not indebted as much as they might have been historically compared to how they had been. So you can see going into the 2008 financial crisis, especially large companies were particularly indebted compared to their earnings. And it's funny that large cap has come down a lot, and really the mid and small cap companies, which have more trouble accessing capital markets and cash, are kind of at historical norms. But I think this is just maybe because of the performance of some of the biggest companies that are wildly profitable. They just have a lot more cash on their balance sheets. So to make a long story short, I think what this chart is saying is, in a recession and stock market downturn, if one does come, the likelihood of large scale bond defaults is probably not as big of a risk as it might have been at certain times historically, which is reassuring to me. And that tells sort of the same thing. So just to close the loop on the Fed, this shows the path of the Fed funds rate over the last 20 years or so. And you can see right now they're estimating that that short-term rates will peak in 2023, and then in 2023 and beyond, we'll start being able to cut again, ostensibly because we have inflation under control. But a lot of people think that maybe this is not even accurate, that this is going to be shifted less. Some people think that the Fed will hike very aggressively now into the end of the year, but towards the end of the year, they might make one final meaningful hike and then be able to pause or potentially even start cutting if it does break the back of inflation, so to speak. And again, just as important as the Fed funds rate and interest rate moves, the Fed's balance sheet, which again, we talked about earlier, is how many bonds they bought and how many bonds they're holding, that as they start selling off those bonds, so you can see they're doing that right here. We peaked at almost $9 trillion of bonds that the Fed owned, which is all part of this this response to the lockdowns of 2020. And they've started rolling off, and now they're starting to sell these bonds. So as this comes down, that's probably going to have a pretty big impact. But it's probably a good thing in the long run if they can do it. But this is very much just as important as whether or not they hike or cut rates or hold them the same. And we're seeing similar things across the board. The Fed has started to turn, just as the ECB is doing a similar thing and starting to turn. And it's interesting to see, this is actually a unique time because you can see what this chart is normalized to is, it says they all started at 100 in 2007, even though they had different values, but just in a relative sense, you can see what happened. But right now, the Fed's balance sheet is 8.9 trillion. And as we talked about, the Fed and the euro, or the dollar and the euro, are at parity. So the ECB, the European Central Bank, has basically got just as much bonds that they bought on their balance sheet as the Fed. And then the Bank of Japan, I'm not sure exactly what the conversion rate is from yen, but you can see they've tapered off. So the point is, globally, and this is probably the three biggest and most important central banks globally, no big central banks are supporting the markets by adding to their balance sheets and buying bonds. If anything, everything is tapering off, and it could be that that we start seeing multiple large central banks starting to try to shrink their balance sheet going forward. So I already talked about that. The federal budget deficit, you can see it looks pretty scary. Even this year after the response, it's not going away very quickly. But if you look at it in a percentage of GDP, which is much more meaningful, I think, because it helps take inflation into account. It's nothing. What we're doing right now is nothing quite like the World War II response, but it is pretty unprecedented. And the difference is right now for the Fed and some of the things we have to deal with for the Fed and the Treasury is that back then we were not we did have some fiscal deficits, but we didn't have a trade deficit. So it didn't have a huge trade deficit, meaning we weren't buying lots and lots of goods and services from other countries. So I think even though this is slightly smaller in the sense of comparing it to GDP, I think this is more concerning to see these kind of deficits because we're not running deficits to invest in the war effort or build factories or roads or anything like that. I mean, you could argue that really we're running a big deficit in a fiscal sense in order to buy stuff from other countries, which is not, it's just consumption, it's not investment at all. So that definitely is concerning and something that they'll have to keep in mind. And ultimately, I think this is the most important thing to think about long-term for everybody who cares about the US and the dollar is the federal debt to GDP. So you can see there's a period where we thought, holding around 40% was probably pretty good. After 2008, we said, well, let's probably try to target keeping it around 100% of GDP. And now, we're up at a point where hopefully we can bring it down. A lot of people are talking about 120% as the limit of what's sustainable there without having big impacts to the dollar and things like that. So longer term, hopefully that'll be something we can do. We're running out of time a little bit, but you can see, I just want to point out that when there are downturns in the stock market, they tend to be relatively short. 3 months, about 2 years, about a year and a half, 7 months. We're already 5 months into this stock market downturn. So it feels like the worst is yet to come, maybe to some people, but to me, I think maybe we've seen the worst of it. I mean, if the market is down on average 20%, unfortunately, our portfolios aren't down that much, but if the S&P is down 20%, I guess I would be surprised to see it down another 20% for sure. So hopefully, maybe this will be one of those shorter downturns rather than a year and a half or 2 years. But even if it is a year and a half or 2 years, that's just an opportunity for long-term investors to acquire more portfolio at more attractive prices. Leading economic indicators are coming down, but we're still pretty favorable in that sense, although of course we could cross below here, which tends to predict a recession. But really the story, I think, of 2022 in the first half is the dollar. It's really surprising how much the dollar has outperformed and continued to outperform. So that's a okay thing, but it's not an all around good thing, because it does hurt our exports, and it does make things challenging in some other macro ways. But we'll definitely continue to watch that with interest. And I think we're a little out of time here. So we're trying to do a better job of saving time for questions. So Chelsea, thank you for coming back on. I just wanted to see if anybody has any questions, please let us know.
We do have time for a question or two. Someone asks, seems like a lot is changing. What kinds of changes are you thinking about for Telarray portfolios?
Yeah, sure. That's a great question. I think something that we need to reiterate for our investors is that we try to be very stable in our portfolios. We really go out of our way to not, well, we definitely don't chase the market, but if the best way I could describe it is we try not to get bored. And what I mean by that is I've seen some firms, and I've worked with some firms that try to have change, I think, for change's sake. They just get bored with what they're doing and they want to try something different, new and exciting. And that can be really devastating to your long-term financial future, not only because you can get whipsawed and essentially, buy high and sell low, but also just the tax challenges of making big portfolio changes and realizing capital gains can have a pretty profound impact on your long-term financial trajectory. So we try to be very stable and not make dramatic changes. But with that said, we're constantly we're constantly evaluating new managers and meeting with new managers and due diligencing our current managers and talking about new offerings they have, examining our current holdings to make sure they're still relevant and appropriate. And so really, I don't see any big changes on the horizon for us. What I like to say is a great example is with the invasion of Ukraine. People asked us after that, they said, well, what changes are you making now that Russia's invaded Ukraine? And my point was, well, if the portfolios we have are inappropriate after the invasion of Ukraine, they were probably inappropriate before the invasion of Ukraine as well, because there's probably hundreds or thousands or tens of thousands of geopolitical risks and events that could kick off at any time. And you can't predict any single one of them, and you also can't prepare for every single one of them. So what you really need is a portfolio that can be resilient in a wide variety of market outcomes. And I would say, again, I don't want to get into a discussion of performance here, but I would challenge each and every one of our clients that are online right now to look at your statements when they come out. And once you get over the unpleasantness of looking at negative numbers for this quarter, which we will, you will see on there, I think you'll see that our portfolios have done extremely well in a relative sense this year. And again, it's just as important to underperform less in bad markets as it is to try to outperform more in good markets. So we're constantly vigilant on our portfolios. And I think we don't really help clients understand that very well because they don't see a lot of changes. We don't make it clear exactly what we're doing, but we're constantly evaluating portfolios and looking at new options. And there's just really nothing we would change at this time. So hopefully that's reassuring. I think we're almost out of time. Is there anything else coming in at this point?
Our time has come to an end this evening. We want to make sure that we are respectful of everyone's time. Thank you again for joining us. As always, we are interested in hearing from you. If you have any ideas or thoughts about topics that we can cover that would be most helpful to you or people that you know, feel free to reach out to the email address that you have on the screen or your advisor or either of us if there is any input or feedback that you have. Again, thank you all for joining us, and thank you, Jean, for the presentation, and we look forward to seeing you all next time. Good night.
Thank you. Thank you, Chelsea. Good night.